My point here is that some people are really bad at business. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of July 26, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Last week was pretty brutal. On Monday, the markets did drop off a lot. I believe the Dow lost 700 points in a single day. It was pretty bad. And one thing that I do kind of want to mention though is it is all about perspective. If you're a newer investor, seeing what happened on Monday realistically could have felt like the end of the world. If you go online seeking help or looking for advice on forums, oftentimes if you're scared during something like what happened on Monday with a 2% decline in the markets, people are very dismissive and they're always like, zoom out, look at the bigger picture. I don't really like that attitude because if you've been investing for decades, then yeah, the whole zoom out thing is a really great piece of advice. But if somebody's only been investing for, I don't know, say the last year or year and a half, then a 2% drop in the overall market could very well be, depending on how they're invested, like a 10%, 20% drop in their portfolio value. So I don't really like the whole dismissive zoom out thing. Remember, everything is relative and everybody can experience the same event differently. So for some people, Monday might have been traumatic. For other people, it's just another day. Personally, for me on Monday, I was looking at stocks that fell disproportionately with the rest of the market, and I was looking for other buying opportunities. But, you know, some people might have just been closing out their trading apps. One thing that's pretty funny, whenever there's a market correction, I end up losing a ton of YouTube subscribers. And I'm just imagining people are just like rage quitting out of everything. They're closing down their trading apps. They're unsubscribing to all of the people they follow on YouTube for finance. They're unfollowing them on Twitter. I don't know, at least that's what I imagine is happening, because I actually lost like 0.1% of my subscribers on Monday during that market drop. Whatever, I digress. Anyway, we've got the S&P, the NASDAQ, the Dow, all at all-time highs. The Russell is still down substantially from where it was in June, but the rest of the markets are doing pretty well. If you looked at the day-to-day price action this week and the advancers and the losers, something that I noticed throughout the week is the market was gaining, but there were fewer advancers than losers. On some days where the market was gaining, it was like a 1-to-4 advancer to loser ratio. That's actually kind of shocking, and that shows how top-heavy the stock market is, and it really shows the importance of keeping blue chips in your portfolio. I know I've talked about it briefly on this channel before, but I've got Microsoft as one of the only single stock positions in my retirement portfolio along with the ETFs, because I wanted to weight more heavily into that blue chip for situations like this. Anyway, to each their own. It is definitely a pretty good strategy, because on days where the market's advancing but only a few stocks are advancing, it's almost always the blue chips. Let's get started with the news. So why did the market fall on Monday? Forbes here is going to give you the dumbest possible answer. The stock market sell-off. Dow plunges 700 points in worst drop since October as Delta variant fears mount. Come on, we've known about the Delta variant for weeks now, for months now. You really think that all of this is culminating on one random Monday at the end of July? Yeah, I don't think so. I'm pretty sure there's other variables here. Or quite simply, the market dropped because there were more sellers than buyers. Maybe people were just taking profits. We've had quite the run up here. So I really hate when news does this. And it's such lazy reporting because it's not actual causation. It's implied causation. Look at the language they're using. As. This isn't because or due to, where they're claiming something is a direct causal relationship. Instead, it's lazy writing. And it's as Delta variant fears mount. Or sometimes you'll see on Delta virus fears. It's always as or on because the news doesn't want to really put itself out there and make a bold claim just in case it's wrong. Instead, it's just loosely linking these two things to imply that that's what's going on. I really hate this type of journalism. I've said it before, I'll say it again. Everything you guys see about investing in the news, always take it with a grain of salt, always double check, always look for additional sources, my content included, because this is just lazy writing. I don't know the reason of the sell-off on Monday, but I'm also not going to say as Delta variant rises. Come on. First real news story of the week. Blue Origin, Jeff Bezos' rocket company plans more tourism launches and the Amazon founder wants to be on one. So here's the rocket right here. Jeff Bezos and Blue Origin's trip to the edge of space is just the beginning. The company hopes to launch 2 more journeys before the end of the year. The company already gained $100 million through ticket sales. This is funny. The still anonymous winner of that auction paid $28 million but didn't make the journey because they were busy. Sorry guys, I paid $28 million for a ticket, but I can't go to space. I'm just way too busy. My schedule is booked with all of these boring Earth things I have to do. And the seat was given instead to Oliver Damon, random 18-year-old. More about him in a moment. Mr. Bezos said the rocket had been designed with the future in mind. Building such a large system and using the fuel it does would be overkill for space tourism, he noted. And the company intends to send people further into space and onto other objects such as the moon in the future. They're looking to reduce costs. They're asking people to book tickets. And Mr. Bezos joked again that he would go as quickly as the rocket, which is built to be reusable after landing itself on the ground, could be filled back up with fuel. So here we go. We've got some people going into space just like Virgin Galactic the week before. Amazon's Blue Origin rocket ended up going a little bit higher, went up to 100 kilometers, and it actually spent about 10 minutes in orbit. We had this giant rocket thrusting up into space and delivering its payload into orbit, where people were able to experience this strange new world of weightlessness flying through the air. Bezos said that eventually this rocket is going to be thrusting forward into the unknowns of space, into different ports. It's going to be landing into welcoming ports all over. The moon, who knows? Asteroids, the space station, maybe Mars. This is a polygamous rocket after all. And it's just looking for a warm, friendly spot to dock in the cold confines of space. Also, the fact that the rocket is meant to be reusable and it can go again after a quick refuel and giving the pilot some time to smoke a cigarette. That's really nice. It sounds efficient. So who is this Oliver Damon, the 18-year-old who went to space with Jeff Bezos instead of the $28 million ticket buyer originally? He became the youngest person to travel to space at the age of 18. Passenger Mary Wallace Funk became the oldest to travel at the age of 82, also on the same rocket. Damon took a year off after graduating high school last year to obtain his private pilot's license. In the fall, he'll attend the University of Utrecht, one of the oldest universities in the Netherlands, to study physics and innovation management. His father has a net worth of more than $500 million. Oh, okay. In case you were wondering how this 18-year-old ended up securing a seat on this rocket, the answer is quite simple. Have rich parents. That's like the top suggestion on anybody says, how do you get ahead in life? Start with rich parents. That's the way to do it. It's good to see that the trend is alive and well here. Next news story, Netflix reported their earnings. The earnings weren't great. I don't really want to go into the financials of them as much as the narratives behind it. There was one negative, one positive. Let's do the negative first. So Netflix bleeds subscribers in the US and Canada with no signs of recovery. Netflix lost 430,000 subscribers in the US and Canada in the second quarter and issued weaker than expected forecasts later in the year, rekindling investor doubts over how the streaming group will fare after the economic reopening. Now, we started to see signs of this on the last earnings report from Netflix, where they were losing subscribers, especially in the US and Canada. Keep in mind, Netflix is global and they have content registered regionally throughout the world, but the US subscriber base is dropping. Now, there's many reasons for this. There's the emergence of other streaming competitors with Hulu, with Disney, with Warner and Discovery partnering up. We also have the numbers naturally coming down from the artificially inflated figures during the pandemic when everybody was stuck at home with nothing to do. But the simple fact remains, whatever the cause, Netflix is losing subscribers and they're lowering guidance. So this is obviously a negative. This looks bad going into the future. And there were even people I saw online this week talking about how Netflix needs to already be removed from the the Facebook, Amazon, Apple, Netflix, Microsoft, Google stocks at the top of the market. And while I don't like Netflix, while I'm no longer a Netflix subscriber, I'm not ready to write them off just yet because of the second thing that they discussed. Netflix opens a new front in the streaming war, and it's going to be focused on mobile games. Almost ignored amid last week's torrent of earnings news was confirmation from Netflix the streaming video service plans to jump into mobile gaming. Investors largely shrugged off the low-key announcement, focusing instead on another quarter of disappointing subscriber growth guidance, but the move has the potential to shake up the nascent streaming gaming market and to resolve some of the biggest concerns about the future of Netflix. This is actually exciting. Mobile gaming brings in a huge source of revenue, and this is why you're seeing large game makers enter the mobile gaming market. They can earn revenue from advertisements, from microtransactions, and as a gamer, I hate the entire model, but this with Netflix is actually going to be coming out a little bit differently. So the Netflix mobile gaming is going to be offered through their platform. They already have a large user base that operates their systems on mobile. So you're basically going to be able to load the games directly through the Netflix app. There's going to be no commercials, no advertisements. So as long as Netflix ends up developing some compelling content that people actually want to play, this could be very promising, and this is a very necessary pivot. The big knock against Netflix is that they were getting outcompeted. You know, Disney Plus opens up a streaming service, pulls all of their content from Netflix. Warner Discovery, eventually they're going to pull all of their content from Netflix if they haven't already, and so on and so forth. Everybody's pulling their content from Netflix, leaving Netflix in a situation where it has to pay exorbitant fees to create its own IP just to remain competitive. And we've seen a lot of that Netflix IP, it's not really the greatest quality. So this is a really cool pivot, and it shows that they're looking to be innovative in the market space, and I'm not ready to write them off yet as a top stock. So what did this all do for the chart? The day that earnings were released, we ended up dropping the next day substantially, like 3.2%, and we've gained back some of that, but still a 3% drop. Even towards the end of last week, we were already heading downward with Netflix. The high over here was 557. Currently, we're down at like 514. The stock has lost a significant amount of its value here over the last couple of trading sessions, but the RSI is hitting oversold, and the MACD9 is starting to flatten out a little bit, so it's looking like we might have a bit of a reversal here for Netflix. For some reason, when I was looking at this Netflix stuff and the fact that they're showing this pliability in their business, this flexibility, willing to try something new, this just reminded me of an encounter that I had yesterday. I went to the farmer's market near my house because I wanted some corn. Farmer's market's typically a really cheap source of vegetables. I didn't want a lot of corn because I'm moving here within 2 weeks, and the last thing you want to do when you're moving is to have to move a bunch of perishable foods with you. So I go into the farmer's market, everybody's set up at their kiosks, all the normal vendors, and typically at the market around the outside there's like single farmers. They don't pay for a booth, but they just set up like a little cart with some of the vegetables they grow at their home. Now I see this old lady that I've bought from before. I think she grows seasonal vegetables or something, because she shows up every couple of weeks and she always has something different, and she always only has one item. So I've bought like, 5 kilograms of sweet potatoes at a time from her, 5 kilograms of regular potatoes, 5 kilograms of carrots. It's always these huge, massive quantities. So today I saw her and she was selling corn. Wow, I wanted corn. Great. So I walk up to her and I ask her for 5 ears of corn. She says no, and she points at the bag. The bag is for 20 for $5. I said, I don't really want 20. I only want 5. And she points at the bag again for 20. And I was like, okay, how about I pay you $5, but you only give me 5 ears of corn? No. I'm thinking, okay, is this a bag issue? Is this a repackaging issue? I have my own bag. I literally just give me corn. You don't even have to husk it. I'll husk it at home. I just want 5 ears of corn. I'll give you $5. And she says no. And so I walk away. Now, it's not like there was a huge line of people for this bag of 20 ears of corn. There was nobody visiting her. Everybody was at another vendor. I went to another vendor. I got the transaction I wanted. My point here is that some people are really bad at business. This gives me hope for the stock market forever. The fact that this lady's been doing this for years, but she is so inflexible in her business model that she can't pivot to take a good opportunity when it presents itself. I know this is a micro scale. This is a farmer's market. This is one old lady. But the reality is there are entire companies that also refuse to pivot and do what's necessary to stay in business. Next up, this isn't really a story, but it's a lead-in to the next earnings report. This week, we had the US developing plans to spend $52 billion on chip supply, and this is from our Commerce Department. The Biden administration is developing plans to quickly spend $52 billion to deal with semiconductor supply issues if Congress passes a bill funding such efforts, the US Commerce Secretary Gina Raimondo said on Thursday. We had Intel falling as forecast underwhelms, chip shortage could prolong. Intel reported their earnings last week, and Intel is one of the largest US chip producers producers. If you remember, Intel's already spending like $20 billion on a couple of foundries of its own, and it's been rumored to be acquiring another foundry for another $30 billion with another company. The company raised its outlook for fiscal year 21 revenue by only $1 billion, an indication that growth might be slowing after a strong year. It also raised the outlook for annual earnings per share by 20%, by 20 cents from the previous forecast to $4.80. Third quarter EPS is $1.10 on revenue of $18.2 billion. The CEO made the comment that the ongoing shortage of chips could spill over into 2023 and that we're helping them build factories as fast as they can. Intel had this pretty good earnings report where they did raise guidance, but it wasn't as high as people were expecting. And also, they reported that the chip shortage is going to carry into 2023, but they're doing as much as possible to alleviate that. And their stock price dropped like dramatically. I think it was 5% or over. And I don't really understand this because the company is spending $20 billion on the foundries. It's rumored to be acquiring another foundry that's already established for $30 billion. And we've also got the US government saying they're going to be pumping $52 billion into alleviating the semiconductor shortage. Who do you think that $52 billion is going to go to? A large chunk of it's probably going to go to Intel because they're the largest US chip manufacturer. It's not like the US government is going to be doling out all $52 billion to Taiwan Semiconductor Company. So I don't understand this sell-off here for Intel. Here's the 23rd, and this is on the earnings report. Intel closed the day before at almost $56, opened the day at $54.58. After hours, we're down to $52.91. And I know that doesn't sound like a really super extreme drop, but that is a 5% drop on a company with a free float of 4 billion shares. So this is a substantial drop, and it's probably going to take a little bit to recover from. All things considered, I don't really understand the sell-off here for Intel. It sounds like it might actually be getting a little bit oversold. It sounds like the company's financials are better than they've ever been. They're investing solidly into the future. And if there's a semiconductor shortage into 2023, this is going to give the Intel foundries time to come online and begin production. So it seems like semiconductor prices are going to remain high throughout this entire time. So Intel is going to be maximizing what limited sales it can make. So I don't have the same perspective on this that the market does. I actually think this entire situation is very bullish for Intel and the other chip makers. Not necessarily chip designers, but chip makers. It's coming, guys. Robinhood is IPOing. It's probably going to be happening this week. So after you watch this video, check it out. Robinhood is IPOing, and I'm not buying. Robinhood is facing looming regulatory risk as it gears up for its IPO. The retail trading platform is reportedly planning to start trading on NASDAQ next week, making a public debut that comes with unusually heavy dose of legal and regulatory disclosures. The company's expecting a market value of $33 billion. Nah. There's no way. And it's facing, by its own words, numerous litigation matters. Numerous makes you think maybe like 4 or 5 or 6. Last count I saw, Robinhood is facing 52 litigation matters. Saying that it's facing numerous is misleading. There was a lawyer that was interviewed for this article. Many of those lawsuits might be dismissed. There's not much substance to them. Robinhood has already settled with the SEC, and it's been fined by FINRA for violating brokerage industry rules. Why would anybody touch this? If you were contemplating an IPO, you normally wouldn't choose the point where you had just been hammered by the media and Congress in the last 6 months. It's not customary for a company that's doing its IPO to have this much on its docket that it needs to disclose, but you can be certain that the underwriters have talked to the prospective investors and don't think it's insurmountable. Robinhood's mounting regulatory risk should be a red flag for investors, and that the stock should be worth no more than $9 billion. $9 billion is significantly less than the $33 billion that they're seeking. Somebody's wrong here in their valuation estimates, and my guess is that it's Robinhood, because Robinhood is really pushing this IPO amid all of these allegations, amidst all of these settlements with the SEC, with FINRA, losing this money, losing their subscriber base. They're really pushing this IPO just for a cash grab to make themselves more liquid to deal with the litigations. Their, I said it, bold claim. This is not something that I want to touch. I mentioned it last week, and I'm restating that this week. Speaking of companies with bad press lately, Didi shares drop on a report that China is planning unprecedented penalties. I talked about Didi last week. week how the app was pulled, new accounts were banned from being signed up in China. This happened right after the IPO, which drove the share price down. It gets worse. Bloomberg News reported Chinese regulators are planning a slew of punishments against Didi, including a fine likely bigger than the record $2.8 billion that Alibaba paid earlier this year. The penalties could also include suspension of certain operations, delisting or withdrawal of Didi's US shares, the report said, citing people familiar with the matter. I'm not saying it's going to get delisted, but that's a real possibility here. If not from the Chinese side, then from the US side. There's already class action lawsuits in the works for this one, and this company does not have much of a future. A $2.8 billion fine or more from China, while that was just a drop in the bucket, while that was a low percent of quarterly revenue for Alibaba to pay, that's going to be monumental for Didi to overcome, and I can't imagine them doing it without it hampering their operations for years to come. If I was holding any shares of Didi right now, I would not be. I would be selling them completely. But hey, this isn't financial advice. You can make that decision for your own after reading all this amazing news. Shares for Didi are not doing well. Once again, here's the IPO on June 30th. We went as high as $18. Currently, after hours, we're sitting at $8.13, but we did go as low as $7.93 already. More than a 50% loss from IPO. Cleveland-Cliffs did report its earnings report last week. Pretty fantastic earnings report. It did miss on its EPS, but it did beat on its revenue. And the real story of the earnings report was not in the numbers. But first, let us look at the numbers. The non-GAAP EPS of $1.46 missed by 5 cents. The GAAP EPS of $1.33 missed by 20. But the revenue of $5 billion beat by 50 million. So higher revenue, lower EPS. Whatever. The company expected third quarter 2021 adjusted EBITDA of approximately 1.8 billion and free cash flow generation of 1.4 billion. Free cash flow generation of 1.4 billion. The market cap of Cleveland-Cliffs is about 10 billion. Their free cash flow for one quarter is about 1.4 billion, so about 14% for one quarter. That's really good. That's obscenely good. So what's the company using this free cash flow for? The CEO, Lourenco Goncalves, echoed what the CFO said in the earnings transcript, both of them saying that the company was going to be debt-free sometime in 2022. This is a cyclical company, a commodities-based company that's going to have no debt, and it's going to be sitting on billions and billions of dollars in free cash flow. What do you think they're going to do with that free cash flow? They're not just going to sit on it. They've already expanded their operations by buying out the ArcelorMittal US holdings. I'll tell you what they're going to do with it. They're going to be returning a dividend. It's going to be a good dividend, probably around 2%. They're probably going to be offering a special dividend because the normal dividend can't pay back investors fast enough before the tax hit. And also, they're going to be doing some share buybacks here within the next year. Cleveland-Cliffs is a no-brain investment in my mind. You buy it, you sit on it for a year plus, suddenly you're sitting on a dividend stock that you got in at a low price, and there's going to be share buybacks, and the company's debt-free. I know it sounds like I'm shilling this, but there's like no downside with the US infrastructure spending coming up. There's no downside here. It's the largest US vertically integrated steel producer. The CEO for Cleveland-Cliffs, in case you don't know, Lourenco Goncalves is a badass. He is like the definition of a straight shooting CEO. He's been in the industry for 40 years and he's absolutely hilarious. And one of the analysts asked him about the carbon emission reduction goal of 25% by 2030. His response to this analyst was hilarious. Yeah, we're totally confident that we're getting there, and we're going to continue to refine these numbers towards targets for 2035, 40, 50. We're going to get there. But I don't feel like at this point there is any need other than for press release purposes to be stating that we will be carbon neutral by 2050 because nobody knows at this point. That's it. Every single company that is committed to that are just telling people what they would like to hear. My 2030 number is real as my net debt zero target, as real as my $9 billion in revenues year to date, as real as my EBITDA year to date. That is a number nobody could have imagined 6 months ago. That's how we do things. We're in the United States, Tristan. You guys in Europe, you talk good game, but the best contribution that Europe can really give to decarbonization in the world is in not subsidizing losers and mavericks that come with proposals just to keep people employed. So Europe sucks from the environmental standpoint. So we are real here in the United States. We have the best footprint, carbon footprint. We have the best carbon compliance clients in the entire world. Europe is light years behind, Japan is light years behind, Korea is light years behind, and China doesn't even make the picture yet. That's the reality. People will start to see that in the very near future. Did that answer your question? Holy shit. If I was that analyst, I would just like politely hang up and leave the call right there, because there's no returning from that verbal assault on an earnings call. The analyst was wondering why Cleveland-Cliffs was only saying that they would be a 25% reduction in carbon usage by 2030, when like every other manufacturer, every other business is saying they're going to be carbon neutral by 2050. Well, there's your answer, because Cliffs is actually giving realistic figures, and they're not just making up numbers from a hat to impress people. Holy shit. Wow. Okay. Moving on. A little update about Brickell Biotech. I realize this is a penny stock and a lot of you don't care about it, but I did cover it in a DD. They announced closing of an $8.05 million bought deal offering of common stock, including full exercise of the underwriter's option to purchase additional shares. This was unexpected, and this ended up driving the share price down this week, but it's not completely terrible. So what's not completely terrible about this is that it is a bought deal offering. It includes the full exercise of the underwriter's option to purchase additional shares. So from the underwriter's perspective, the bought deals are usually priced at a larger discount to market than the fully marketed deals, and they may be easier to sell, and the issuer client may only be willing to deal if it is bought, as it eliminates execution or market risk. So here we have Brickell Biotech very confident that the shares would sell. They wanted to raise some capital since they don't really have the US income yet, and they're getting towards the end of their phase 3 trials. So Wainwright, HC Wainwright, which was the underwriter, ended up executing this bought deal offering, and they increased the amount 3 times this week. Originally it was 5 million, then it was like 7.5, and then it ended up being over 8, which means the demand was really, really high. Now for this bought deal offering, a lot of this ends up going to institutional buyers, and it goes at a discount. The offering was made at 62 cents, which was like a 15-cent discount off the trading price at the beginning of the week, which is why the trading price dropped. This ended up being for something like 13 million shares, which was a pretty substantial position compared to the shares outstanding of Brickell Biotech, but they still have the catalysts coming up, and they have to regain compliance above $1, so I'm not really too worried about this. It's a good way for them to get the cash inflow, and the catalysts are going to drive the price up anyway. Let's take a look at the earnings for the upcoming week. Wherever you look, there doth be a feast for thine eyes. We've got just the top line alone: Lockheed, Tesla, Apple, Boeing, Facebook, Amazon, Exxon. I mean, just going down, everybody. Shopify, they support StarCraft. I love Shopify. PayPal, just McDonald's. I can't even name all of the amazing companies that are reporting this week. The company that I do want to talk about, and yes, holy crap, I'm back. I have an options play of the week. It's Valero, reporting on Thursday before open. Valero is a US-based independent petroleum refiner and ethanol refiner. They end up running gas stations. They sell gas, okay? We are right now in the summer season, so this earnings report is going to have May, June on it. Gasoline costs typically go up during the summer months. People are traveling more. Last week, we saw with the Las Vegas Sands research that people were actually electing to travel by car even more because planes were feared to be hotbeds for COVID transmission, and people feel more safe traveling in their car. So we can take that Vegas statistic as a microcosm and expand it and say, hypothetically, people are most likely traveling by car more this summer than in previous summers. We had huge news out of OPEC this week. So OPEC and its allies target full end to oil production cuts by September 2022, which increases the supply limits as the prices climb. Abu Dhabi had demanded that its own baseline for crude production, the maximum volume recognized by OPEC, would be able to be produced to be raised. So OPEC is this organization with a bunch of different members, and Abu Dhabi wanted to raise its production limit to put more oil onto the market. The problem is OPEC has to work in tandem, so it needed the approval of the other members. The other members weren't giving it, and Abu Dhabi was really unhappy, and they're one of the larger players in the group. There was a bit of turmoil this week as this situation was sorted out. The OPEC and non-OPEC allies reached a deal on Sunday to phase out 5.8 million barrels per day of oil production cuts by September 2022 as prices of the commodity hit their highest levels in more than 2 years. Coordinated increases in oil supply from the group will begin in August. This is where everybody just kind of stopped reading. The market reaction to this was dumb. They read read that oil production was going to increase, which caused the price per barrel of oil to drop sharply, but then it ended up recovering, and this was just a knee-jerk reaction to the news. This is actually kind of bullish because supply that's being increased is almost inconsequential compared to the cuts from before. Overall production will increase by 400,000 barrels per day on a monthly basis from that point forward. The International Energy Agency estimates a 1.8 million barrel per day shortfall for the second half of the year, indicating a tight market despite the gradual OPEC supply boost. Even with this addition to oil supply, many forecasters are expecting to see oil trading at $80 a barrel in the second half of 2021. So that's the backstory. That's the macroeconomic situation. We've got OPEC releasing some of the strain on the oil costs, but it's still not enough to combat the demand, and oil prices are still going to be rising. As of the recording of this video, I think oil's around $73 a barrel. It dipped below 70 briefly this week on that OPEC news, but it's back up above 70 because suddenly everybody realizes, oh wait, no, this is still a real problem. Now, what about gas prices in the summertime? At the beginning of this segment, I talked about how people drive more during the summer months. We can see that gas prices are really high right now. If we go through the last 3 months of the quarter, June, May, April, so this is going to be the second quarter, they've been high, consistently high the entire time. So here's the 3-month chart. We could see Valero is actually below where it was in April leading in. We've actually fallen off pretty hard. If we're going to do an options play, what about the volatility? The implied volatility is 39.8 right now for the IV, but the historical's 38.48. So right now we're sitting about 1.5 percentage points above the historical volatility, and we're heading into earnings week. That's not bad. Usually it's much higher for the IV. So the option prices are not going to be terribly expensive here. And if we look at the last couple of earnings reports for Valero, they've consistently beat the earnings estimates. And what's really notable about this one, check this out. All of these earnings estimates are negative and they're beating them conservatively. This means the company's reporting conservative figures that it knows it can beat for a psychological lift on earnings. The Q2 2021 estimate here is for 50 cents on the EPS, which is going to be its first profitable quarter in probably 2 years going back to COVID. So psychologically, even if this is an EPS slight miss, they're going to be profitable this quarter. And here we've already taken a huge beating with the OPEC news, with the OPEC uncertainty. And check out the RSI. We've been oversold for a really long time, basically throughout this entire drop. And right now the RSI is still in oversold territory. The MACD is incredibly low right now. This is screaming reversal. And even towards the end of last week, this was on the OPEC agreement news. We ended up dropping and finding a bottom around $60. Here we're sitting right now at 63.71, after hours 63.65. What am I going to do for options? Now we see historically after earnings, sometimes it takes a couple of weeks for the rise to happen, about 10 trading days. So I don't want to be playing a weekly here. So what I'm actually looking at doing here is going out about 55 days to mid-September. And because we see that 60 is a little bit of a floor right now, I want to go ahead and buy these $60 calls. The calls right here are selling for $555, so that's $555 per call option. And this seems like a pretty solid play. Maybe I'll buy 1 or 2 calls here for the September 17th expiration. Now for these options, it would be safer to go out further, but obviously the further you go out, the more expensive the options are. We can expect a good earnings report here from Valero. We know that the oil price is going to be climbing again. It's already recovered from the dip on the OPEC news, and it's not like OPEC news comes out every day. Also, Russia seemed to be pretty in agreement with the OPEC announcement as well, so there's not really going to be any international situations. This seems like a stable situation. The RSI is oversold, the MACD is really low. The earnings report should be the first positive EPS in over a year. Like I said, I'm going to go out 55 days to September 17th and go ahead and grab those $60 calls. 60 seems to be the local floor for the price anyway. That's it. That's all for me today. I hope you guys enjoyed the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account using that referral link, deposit $100, you get a free stock, I get a free stock. Everybody wins. If you enjoyed the video today, please like the video. Subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck trading. Have a green week, and I'll see you next time.